Bitcoin's going higher, gold's going higher, stocks are going higher, because ultimately we are going to get asset inflation.
According to Pompliano, Bitcoin is beginning to transcend its previous identity. It is no longer just correlated with tech stocks or treated purely as a high-risk investment. Instead, it is being recognized for its core properties. It is digital, making it easily transferable across borders. It is decentralized, meaning no single authority controls it. It is non-sovereign, existing outside the influence of governments. And most importantly, it is neutral. In times of conflict, neutrality becomes incredibly valuable. Think about it. Moving physical assets like gold becomes difficult. Transporting oil may be impossible due to blockades. Traditional banking systems can be restricted or frozen. But Bitcoin, it moves instantly, globally, and without permission. This is where its value proposition strengthens, not as a speculative gamble, but as a functional, resilient financial tool in a fragmented world.
There's a couple things, like celebrating when you're down is really not, the smartest thing to do. But I do think that there's a sign of relief here. People are excited because, hey, we're starting to see that maybe we did bottom at $60,000. Now, famous last words, let's knock on wood. But what I would say is two things. One, Bitcoin has definitely been the shining light among a sea of red during the Iran war. And so there's kind of this weird dynamic where if you said to someone before we went into Iran and started bombing them, okay, what's going to happen to stocks? People would say they probably would rally, because you would think that all of these asset prices are going to go up because there's going to be inflation to fund the war. You're going to debase the dollar. And because of all of that, you're going to see, especially defense stocks, energy, etc. The second thing is you would expect oil to go up. The third thing is that you would expect bonds in terms of yields and all that. And then the fourth is Bitcoin would go down, kind of a risk type asset. Well, guess what happened? Exactly the opposite of all of that. Stocks and bonds went down, gold went down, oil went up, which you would have expected, and Bitcoin went up, which you would not have expected. And so when I look at that, it says to me that one, you can't look at history always as a guide for what's going to happen in the future. But two is that Bitcoin has transcended. It has officially broken its correlation to all of the tech stocks, et cetera. Now, can it hold that broken correlation? Remains to be seen. But I say it has transcended because Bitcoin basically has a couple of different ways to look at it. It is a digital asset. There's some people who like the fact that it's digital and not analog or electronic. It is decentralized. Some people like the fact that it's not controlled by anyone. It is non-sovereign. Some people like the fact that it's outside of their government. No other government controls it. And it is neutral. And I think that's what we're seeing now is people are saying, wait a second, a neutral, non-sovereign, digital, decentralized asset has value in the world. And a big part of this is, yeah, sure, Iran allegedly wants to get paid in Bitcoin, blah, 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 whatever. Forget all that for a second. If you need right now to move money around the world during conflict, well, you can't even move a barrel of oil around the world in some places because there's a blockade. Gold is pretty heavy. Now you start to say to yourself, wait a second, what if I need a digital store of value? Bitcoin becomes interesting. Now, what I do think is interesting is that Bitcoin is still sold off. So we can claim victory since February 28th to now and be like, oh, look how great we are. Okay, that's fine. Bitcoin's still down. It was $126,000, it's down to $75,000. I'm not a mathematician, but that's about $50,000 of loss from the all-time high. And so from that perspective, you say, okay, well, why is it that Bitcoin is still down 11% year to date or down, $50,000 from its all-time high? I believe that a huge part of this is because of deflation. And there's plenty of people who disagree with me. Everyone says higher, gas prices are going to lead to inflation, yada, yada, whatever. I do not believe that the short-term impact on oil is going to be nearly as important as the four macro deflationary trends that are swallowing the US economy. Tariffs are deflationary, deportations are deflationary, AI is deflationary, and robotics are deflationary. And I think those four forces are a much, much bigger deal than the short-term spike in oil. And as we saw, we announced that, there was a ceasefire, immediately oil drops. Now there's a blockade, there's all the volatility coming back, prices going higher, all this stuff. But if we get to a culmination and an end, like an actual end to the Iran war, and the strait opens up, oil is going to fall off a cliff. A barrel of oil is somewhere around 50 to 60 bucks if there is no funky business going on in the world. Okay, well, if it's trading at 100, that means it could drop 50%. So you say to yourself, a lot of the current price increase in oil is due to these artificial external shocks to oil. Well, that then trickles through to gas prices being higher. And if all of a sudden you remove those external shocks, sure, is it going to come right back down on a single day? Probably not. But we saw it drop down to $80 a barrel as soon as we announced the ceasefire. Well, what if we actually announce a peace deal and it becomes known in the market we are no longer bombing Iran? I think that you're going to see oil come down. I think you're going to see stocks rip higher. Stocks are back already green on the year. So, I mean, imagine being a panicking. What? I mean, that's just like a loser life, right? Just think about how crazy that is. Every time you get a sniff that there could be some sort of bad situation coming, you immediately panic. That's what a panicking is for those that don't know. You just panic all the time.
Emotional investor.
Yeah, not even emotional. You don't have brain cells, right? Tariffs are coming. Oh my God, the world's going to end. The shelves are going to be empty. Inflation's going to be high. The Great Depression. Ah! Remember how crazy everyone was? Do you remember what I was saying in April of last year? We would be back to an all-time high stock price by the end of the year. We were back by like August. Why? Because all noise. It is all noise. It is an overreaction from the mainstream media and from investors who have an academic view of the world. Okay, guess what I've been saying this entire time? Short-term oil prices and gas prices are all noise. How do I know that? Well, we just got the PPI today. The expectation across Wall Street for PPI, headline PPI, was 4.6%. That's a massive jump. It was 4%. How do you miss that bad and keep your job? How's that possible?
Here's where things get really interesting. We typically think of deflation as negative for asset prices, but Pompliano introduces a different possibility. What if we experience consumer deflation and asset inflation at the same time? In other words, goods and services become cheaper due to technology, but assets like stocks, real estate, and Bitcoin increase in value. How could that happen? Monetary policy. If governments respond to deflationary pressure by injecting liquidity, printing money, or lowering rates, that capital doesn't just sit idle, it flows into assets. And when investors lose confidence in holding cash, they seek stores of value. That's where assets like Bitcoin come into play.
Bitcoin's going higher. Gold's going higher. Stocks are going higher. Because ultimately, we are going to get asset inflation. See, one of the weird things is people want us to have a black and white world. So if I tell you, hey, deflation is likely to happen, right? Or it's the bigger risk, then people say, okay, well, if there's deflation, then asset prices actually usually go down. Okay. But then if I tell you, but the government is going to be incentivized to print more money, and that money is going to find its way into assets, because now people are convinced I shouldn't hold this cash. I'm not predicting this necessarily, but I think that there are higher odds that we could get asset inflation while consumer inflation does not get out of control. The way to think about this is, could we have a low inflation, high growth economy? It's like a central banker's dream, right? Is I don't have to juice the economy that much because we're getting the high growth already, and inflation is staying, low and manageable. Okay, well, how could we get that? Well, could we drive growth from artificial intelligence, robotics, crypto, name your space, right? Name all of these kind of innovative technologies at the same time that those technologies are deflationary from a consumer standpoint? 100% we could. And so guess what is starting to happen? We're seeing that play out. Sharpie, the maker of your favorite marker, they somehow reshored their manufacturing, used robotics. They are paying their employees more money. They didn't fire people, and they have better margins. Let's just use a simple example. If you have a factory and you have 100 employees at that factory, and those 100 people you're working them to the bone. You got to get the work done. There's no robotics, there's no machines, there's no anything. Okay. Well, let's say that those 100 people can produce, I don't know, use easy numbers. They can produce 20 units of your good every single day. All right. If you start to actually introduce machines, guess what happens? You first start machines augment the people. So now those 100 people can produce not 20 units, maybe they can produce 22 or 25 units. Well, your cost in terms of running day-to-day labor is a big input, maybe the biggest input, stayed the same. You still have 100 people working there, but now you're producing 25 units instead of 20. Well, if you have healthy margins, then you're likely to make more money. And you know you have healthy margins because the machines are making the same number of people more productive. Now, are there CapEx expenses? And there's nuance, right? But generally, that's the idea. But what we're seeing is, well, what if you don't go from 20 to 25? What if the machines have you go from 20 to 50? Well, now you have more profits. You didn't fire anyone. So you, as a business owner, can make more money and pay the employees more money because you have more money to work with and you're more productive. So what you've done essentially is you've increased or held your profit margin. You've got more profits as a business owner and your employees are better paid. How is it that Elon is able to pump out as many cars as he does? Robotics, right? So you look at it like Sharpie's a good example. That is pretty much the story of Sharpie is they invested in technology and they were able to do this, right? And it didn't have a negative impact on employees. See, one of the things that I've changed my mind on is one of the things I've changed my mind on is the impact of artificial intelligence on jobs. Are there a lot of people who are going to have to retrain themselves and get new jobs? 100%. But there will be more jobs in the economy, not less. What do I mean by that? Well, let's look at software engineers as an example. Basically, AI came out and we saw software job openings crater. Well, guess what? Now they're up and they're growing rapidly. There's more job openings today than there was when ChatGPT came out. Why is that? Well, if I can take this technology and I can hand it to an engineer and that engineer is now more productive, as a business owner, I'm incentivized. How do I get as many of these people here as possible so that I can make them more productive so I can grow faster and accelerate and drive more profits and become more valuable? So in a weird way, what we're doing is we're actually opening up the pool for a company and we're saying, look, for every dollar you invest in talent, you're actually getting more units of productivity from that dollar invested. So you're incentivized to invest more, not less. And so I think that the AI job loss narrative is real in certain industries, but ProCap Insights, the research firm that we recently announced, what they're doing is they're using artificial intelligence to sift through mountains of data, find these insights, and then AI is actually writing the report. So it's the first agentic research firm on Wall Street that we're aware of. Full bore AI writes the whole thing. One of those reports talks about the fact that actually there's a lot of job loss for people between the ages of like 22 and like 28. But there is job increase, job growth for people over the age of 30. And so if you want to read that report, you can go to procapinsights.com. But in that report, you know what I took away from that? Experience just became more valuable. So now it is not only, hey, do you understand the technology, but do you have experience? And so if you put this stuff together, you realize like artificial intelligence is going to be a productivity boom, but there is going to be deflation because the cost structure changes. But just because cost structure changes doesn't mean all of a sudden companies stop growing. Actually, the opposite. They accelerate. You know, one of the industries I'm very interested in is data labeling. I don't know, I could probably rattle off 8 or 9 companies that either started going after this or were like defunct bad companies. There's a company called Handshake. I don't know if you know this. No. So there's a company called Handshake. They've been around for 12 or 13 years. It was going like okay. I think last January, they did like $1 million of revenue or something. Like they were on pace to $1 million of revenue. Then a couple of months later, they were 5 million. I think they ended last year doing like 100. Then ARR. 100 million in ARR. Then they're up to I think 500 million like a month or two ago. And now I think they're doing $1 billion.
Perhaps one of the most important takeaways is behavioral. Markets are emotional. Investors panic. Media amplifies fear. But time and again, those who react impulsively tend to lose. Pompliano criticizes the tendency to overreact to every negative headline, whether it's tariffs, war, or inflation scares. Because in many cases, these events are temporary disruptions, not long-term structural changes. And history shows that markets often recover faster than expected.